Welcome back to the channel. I hope you guys are having a great day. So today we have to talk about a potential violent break in volatility in the Bitcoin markets. Whether it's to the upside or the downside, I'll let you decide, but we have some important on-chain and off-chain data to look at to help us understand maybe not the direction, but when this volatility could be coming. And on top of that, I also have some important considerations for the long term in terms of Bitcoin's price action, where it might go. So that's definitely something you're going to want to stick around for. And if you enjoy the channel and the content that we produce on a daily basis, make sure to subscribe and like the video down below, as it really does help us. But let's get right into it. So as you know, on this channel, we really like to look at data, what's happening on chain and off chain. What is Bitcoin telling us in terms of the movement, the open interest, the volatility, the everything, right? And one of the things that's very important this week is that we might be getting a lot of volatility in the markets, whether it's to the upside or the downside. Again, earlier, like I said, I really don't know, but let's take a deeper dive and then maybe you guys can form your own consensus on it, and then I'll tell you my thoughts at the end. So what we're looking at is the Bitcoin 1 week realized volatility. So as you could see all the way back, this is a little bit of an eye candy chart, but basically this red line, this red squiggly line that we see, anytime that the realized volatility is at 28% or lower, you could see them highlighted by these blue areas that I just circled right here. Basically what this means is that when there's a little bit of volatility in the markets, it's met by a violent move in the market. Why? Because volatility will just come in out of nowhere. And as we know, Bitcoin is volatile. The cryptocurrency markets are volatile. And if they stay stagnant for long enough, then obviously volatility is going to come back. Now, if we look at the historic times that Bitcoin has fallen below the realized volatility of 28%, it's happened basically 4 major times. Over here in the 2015 bear market, what we had was both of them ended up in rallies. So you could see the market kind of moved up, and then we had our massive rally in the 2018 bull market or 2017 bull market. The other time though was our $6,000 floor, right? Bitcoin was stagnant for so long, and then out of nowhere, that volatility came in, but to the downside. And then the 4th time it happened, again, as you can see right here, volatility came in and then pushed the markets up. So 3 of the 4 times it ended up being bullish, but I think the time that looks most specific to the past is what happened in the $6,000 floor. So let's actually look at the good. So if you're bullish or you're a bull in this market, then this is good news for you. As you can see, over 48,000 Bitcoin were bought, which is just shy of 1 billion. You could see that anytime there are these massive buys, which doesn't happen very often, you could see that a lot of these massive buys happen at lows, which again, whales and institutional investors like this love to buy at dips. They love to buy at lows. And typically they probably have some, inside information that kind of tells them that the market may be going up. But as you could see me marking off all of these points when they've bought the markets, you could see that literally every single time it's rallied. So when they bought over here, the market rallied, it rallied up, right? So they're buying at these lows, and as they buy at these lows, these markets tend to rally. So an indication is we just saw 48,000 Bitcoin being bought at a very strong low. Historically, that's a very bullish sign, and the markets could rally. But there is one thing that I want to kind of show on the opposite side. When you're looking at the options implied volatility, we are also at a point where it's very bearish. So as you can see, the options volatility is at an all-time low at 48%. And the times that it's been at this level are the pre-Terra Luna collapse right around here in early April. And then we have our yearly open, which is when the bear market really started to fall. And again, our April 2021 high, which again, we know if we're looking back at the November high or the double top, a lot of that was leverage. What we really should have seen is a collapse in the markets in April, if we look in hindsight. But what we had was leverage and short-term markets really determine a new high, and then we really started to bottom. And we could be seeing the same thing here, but kind of in a reverse context where we should be going up in a bull market, but we could get that lower low or double bottom. Now, neither good or bad. What we're looking at though is that short-term holder SOPR, which is spent output profit ratio. This is basically telling us where are short-term holders. Are they losing money? Are they making money? And whether at this 1.0 equilibrium, it's kind of in the middle. But anytime this gets rejected, you could see it also comes with massive sell-offs. So we are in a very unique spot where historically, if we reject off of this level and short-term holders start to lose the markets, then we could see a massive move to the downside. Why? Because again, there's implied volatility at all-time lows. There's not a lot of futures options that are in here. And so a large surge of money out of nowhere could make the markets very violent and very volatile. And again, if it's in the downside or short-term holders start to sell, it typically turns into this domino effect, because as the order book starts to get taken out and price starts to go down, then people get deleveraged, margin called, and then that continues to push the market down in price. And again, like I was saying, if we look at the futures options open interest, then we are currently at all-time highs, basically meaning we are kind of sidelined waiting for a lot of this volatility. While yes, some of the implied volatility is at its lowest, the open interest, there's a lot of people speculating, there's a lot of people hedging, and so there's a lot of people placing their bets in the short term, which could again bring a lot of this volatility, especially if a massive price move is coming. And I'm sure there's people on both sides. When we look into the Bitcoin chart, there's people on the bullish and the bearish side, and whichever side gets taken out more, it's going to again deleverage a lot of those people, causing a domino effect. So one thing I really wanted to bring up is that if you look on Glassnode, they kind of put this weekly newsletter together, and that's where I got a lot of this information. And what we're looking at is exactly what I brought up in the 2021 high with the double top. We could be looking at the opposite with the double bottom in this red highlighted zone that I have. It says we can also note that almost the exact opposite set of conditions was prevalent at the April 2021 high, which we have argued was the true end of the 2021 bull market. So what we could be looking at is that maybe, just maybe, we are looking at a potential double bottom, right? Something where we should be seeing the bottom, but because of the open interest, the volatility in the short-term markets, it could push us even lower than we're actually supposed to go, right? We have long-term holders and we have a lot of money sitting at 19,000, and maybe that should be the bottom. But is there a chance that we go lower? I think it's a really good chance, especially with what's happening in the macro. And speaking of everything that's happening, so if I go ahead and mark out some of these charts, what I personally see is that there's two very important zones that we could be looking at. So obviously the first one, I'll mark this red. We could think of the red as margin call areas, or stop losses, so to say. So there's two really important areas that I personally believe inside of the upside, which is right here. And then what we're going to do is mark the bottom, which I think again serve as a very important zone. So what we could see is obviously there's probably a lot of money. Imagine there being a pool of short-term holder money, open interest, people speculating, people hedging, and people think that maybe the market goes down, so that you have a lot of bearish sense. And so their margin call is going to be on the upside. Well, you also have a lot of people that think the market's going to go up. It's going to rip to the upside and we're going to get a bear market rally, or maybe we just get a bull market starting. Who really knows? But if we do get a push to the upside, then a lot of your sellers are going to start getting margin called, and I'm sure a lot of their liquidity is above these highs, and again above these highs, potentially over here, but that's a decent ways away. As if we take a look at the current market structure, we're currently around 30%, which we could possibly make, but I think it's a little less likely. So what I'm trying to say is that whatever direction Bitcoin does choose, because we believe, and I'm pretty sure that volatility is coming, I don't know which way, to the up or to the downside, but if it does end up going to the upside, you're going to see a lot of deleveraging in the short term sellers, right? So short-term sellers are going to get margin called, they're going to get deleveraged in these markets, and then again, the same for the reverse. If Bitcoin starts to go down, a lot of these bulls are going to start getting margin called as well. So it'll be interesting to see what happens. Now, what I could see happening is a bear market rally where we do start taking out these highs and we do start reaching over here. That's going to bring a lot of hope back into the markets. A lot of short-term buyers are going to be in profit. We're going to see a lot of buying pressure, and eventually what's going to happen is that if you take a step back and realize what's really going on in the macro, all right, I'm not saying that we can't have a bull market right now, but do you really think that's the most likely scenario? Probably not. And if we take a look at the main issue, I mean, inflation is still at insane highs. Yes, it has gone down, but it's going down extremely low, right? Over the past, since June, over the past 3-4 months, it's gone down 1%. So it's not showing us that these interest rate hikes are doing much. Yes, inflation is going down, but when you actually look at the real core inflation, the thing that the Fed is looking at, well, we've got an opposite story, because headline inflation is going down from 9.1 to 8.2%. But yet, if you look at the same time frame right around June, we were at 6% for core inflation, and now we're at 6.7. So I heard a lot of people saying that yes, inflation is coming down. The Fed is probably not going to raise 75 basis points because it's looking good. You know, inflation is destined to come down, whatever. But when you look at core inflation, which is again the main thing that the Fed looks at because it's less volatile, you can see that we have the opposite effect, and inflation is actually only getting worse. So that's going to put more pressure on them to continue to raise those interest rates. In the long term, until the Fed actually pivots, until they stop raising interest rates, and until they potentially start cutting rates, the markets aren't going to rally in this type of an environment. And as a lot of us have said, I mean, if they raise it by 75 basis points, we're going to reach a rate hike of right around here at 4%. And then the next one, you know, a lot of people are speculating that 4.75 and 4.5, this is kind of the terminal rate. This is where they're going to stop. Now imagine down the road, inflation doesn't get any better and they have to continue to raise it and they go past the terminal rate. That's going to be extremely bad for the markets. The markets are going to price that in because they're forward looking. And before it even happens, we're going to get another push to the downside, which could bring a lot of volatility. So while in the short term, we might get a bear market rally, in the long term, if inflation doesn't go down and we have to go past our terminal rate, let's say 4.75%, and we have to go past that, well, the markets aren't really pricing that in. And so that's going to be very bad for the markets and people are going to react very badly to it. So while yes, you might be optimistic in the short term, and for short-term traders and holders, this is a really good sign. Maybe volatility is going to go and push us back to the upside. But I think when you take a step back, when you take a look at the macro, what's really happening, what's really going on, I still see a little bit more downside coming, right? I think these floors are too obvious. I think there's been too much time to accumulate, and I think too many people are still holding on and there hasn't been that main capitulation happen. While yes, the markets have dropped multiple times, taking out a lot of people, if you look at just normal bear markets, they typically last around 2 years. If you take it from the November high, we've only been in for a year. From April, about 1.5 years. So we still have some more time pain. And in terms of price, we're still 10% away from a typical bear market. And then if you look at the S&P 500, we also have some room to continue to drop to the downside in a true recession. So that's everything that I had for this video. If you guys enjoyed it, if you guys found any value from it, I'd highly appreciate if you could like and subscribe to the video. Leave a comment down below of what you liked about the video, what we could do better. And until the next time, we'll see you guys then. Peace.